On the morning of September 15, 2008, a bank that had survived for 158 years ceased to exist. Nothing in the numbers Lehman Brothers reported to investors said it was about to. But in its final months, according to the report of a court-appointed examiner, the firm was removing as much as $50 billion from its own balance sheet just before the end of each reporting quarter, and presenting the better-looking numbers to investors as good news. The examiner called the result materially misleading. Those are the findings of a civil report, not a criminal verdict. No Lehman executive was ever criminally convicted over the collapse. The firm's former chief executive later testified he had no recollection of the maneuver, and Lehman accounting personnel have contested aspects of the examiner's conclusions. Then, in a matter of days, it filed for bankruptcy, the largest bankruptcy filing in the history of the United States. Its stock had collapsed by 93% in a single day, and its failure did not stay contained inside one firm. It is widely seen as the trigger for the acute phase of the global financial crisis of 2008, a panic that froze lending around the world and helped erase trillions of dollars in market value. During the housing boom of the 2000s, Lehman moved aggressively into the subprime mortgage business, loans made to borrowers with lower incomes and weaker credit histories. It did not just lend. It packaged mortgages into complex securities and held large quantities of them on its own books. These were among the riskiest loans in the market, and Lehman's exposure to them and to related real estate grew enormous. But the mortgages were only half of the problem. The other half was how Lehman paid for them. The firm had been founded in 1850 and had lived through the Civil War, 2 World Wars, and the Great Depression. But it was not a bank in the everyday sense. It did not take deposits from the public, so it had no stable pool of customer money underneath it. It did investment banking, trading, and asset management, and over the decades it had reinvented itself several times. That left it financing its long-term, hard-to-sell assets using very short-term debt. It borrowed enormous sums in the overnight markets, money lent for a single day at a time, then rolled over and borrowed again the next day. This is a common practice on Wall Street, but it carries a fatal vulnerability. It depends entirely on lenders being willing to keep lending every single day. A firm funded this way is only ever one loss of confidence away from a crisis. On top of this sat leverage. Leverage is the ratio between what a firm controls and the actual equity capital it holds as a cushion against losses. By mid-2008, Lehman's leverage was reported at roughly 31-to-1, high even by the standards of Wall Street at the time. In plain terms, for every dollar of its own capital, Lehman was carrying about $31 of assets. At that ratio, it would take only a small percentage decline in the value of those assets to wipe out the firm's entire equity. So the structure was this: enormous holdings of risky mortgage securities funded by debt that had to be renewed daily, balanced on a thin sliver of capital. As long as the housing market held and lenders stayed calm, the machine kept running. When both of those assumptions broke at once, the firm had almost nothing underneath it. For years, the strategy looked like success. The housing market rose. Mortgage securities generated large profits. Lehman's aggressive posture in real estate made it, for a time, one of the most profitable firms on the street, and its leadership was celebrated for the risk-taking that produced those returns. High leverage in a rising market magnifies gains, the same mathematics that would later magnify the losses. But beneath the profits, a problem was building on the balance sheet, and here the story turns to the accounting. By 2007 and into 2008, the market for subprime mortgage securities was deteriorating. The assets Lehman held were losing value, and its leverage, that 30-to-1 ratio, was exactly the kind of number that investors, lenders, and rating agencies watch most closely. High leverage signals fragility. If Lehman's reported leverage climbed, confidence could fall, lenders could pull back, and the whole short-term funding structure could seize up. According to the report later produced by the court-appointed bankruptcy examiner, Anton Valukas, Lehman used an accounting maneuver to manage exactly that appearance. The maneuver had a name inside the firm, Repo 105. A repurchase agreement, or repo, is an ordinary financing tool. A firm sells assets for cash and agrees to buy them back shortly after, for a slightly higher price, in effect, a short-term loan using the assets as collateral. Normally, this is treated as what it is, borrowing. The assets stay on the books and the debt is recorded. Repo 105, according to the examiner's report, was structured so that these transactions could be treated not as loans but as true sales. The distinction mattered enormously. By classifying the deals as sales, Lehman could temporarily remove the assets from its balance sheet entirely and use the cash it received to pay down other debt, just before the end of a reporting quarter. The effect was cosmetic but powerful. At quarter end, when Lehman published the financial statements the whole market would scrutinize, roughly $50 billion of assets could be made to temporarily disappear from the books, making the firm's leverage look meaningfully lower than it actually was. Days later, after the reporting date had passed, Lehman would borrow the money back and repurchase the assets, and the leverage would climb right back to its true level. The examiner found that Lehman had first used this technique as early as 2001 and had become increasingly dependent on it in the months before the collapse, removing as much as $50 billion at quarter end. Crucially, the report concluded that Lehman failed to disclose its use of this device even as it presented those lower leverage numbers to investors as good news. In the examiner's words, that combination created a materially misleading picture of the firm's true financial health. It is important to be precise here. These conclusions come from a court-appointed examiner's civil report, not from a criminal conviction. No Lehman executive was criminally convicted over Repo 105 or over the collapse. When the technique later became public and a civil lawsuit followed, the firm's former chief executive, Richard Fuld, testified that he had no recollection of hearing anything about Repo 105 transactions while he ran the firm, and Lehman accounting personnel have contested aspects of the examiner's conclusions. What is not in dispute is the underlying reality the maneuver was managing. Whatever the reported number said at quarter end, the real leverage and the real risk were still there. In 2008, the assumptions holding the machine together broke all at once. Subprime mortgage defaults accelerated. The value of the mortgage-backed securities on Lehman's books fell sharply. Because the firm was leveraged roughly 30-1, those losses cut straight toward its thin layer of equity capital. Rating agencies downgraded Lehman's holdings, and the firm began reporting enormous losses. Then came the part that actually kills a firm funded by daily borrowing. Confidence evaporated. As Lehman's condition worsened, other institutions grew unwilling to keep lending to it or to accept its securities as collateral. Firms like its trading counterparts began demanding more collateral on loans, making it harder and harder for Lehman to fund itself each day. This is the specific danger of relying on short-term markets. Lehman needed to borrow billions of dollars every single day just to operate. The moment lenders stepped back, the firm could not simply wait out the storm. It faced the prospect of being unable to fund itself by morning. A crisis of confidence became a crisis of cash almost instantly. In the days before the bankruptcy, the Federal Reserve summoned the major banks to try to arrange financing or a rescue for Lehman, much as arrangements had been made months earlier when another major firm nearly failed. Potential buyers were sounded out. Negotiations were held through the weekend. That earlier near-failure matters to the story. Only months before, when the investment bank Bear Stearns had collapsed in the spring of 2008, the government had helped engineer a rescue that protected the firm's trading partners from catastrophic losses. That intervention created a widespread assumption in the market that the authorities would not let a major, deeply interconnected Wall Street firm simply fail, because the damage to everyone else would be too great. Many investors and counterparties appear to have believed, right up until the final weekend, that some version of that safety net would appear again for Lehman. That assumption shaped behavior. It is part of why the shock was so severe when the rescue did not come. The market had priced in a backstop that, this time, was not provided. But this time, no rescue came. The discussions failed, and the Federal Reserve and Treasury did not provide the backstop financing that might have kept Lehman alive or funded a takeover. Whether that decision was right or wrong has been debated ever since, but its immediate effect was decisive. Without a buyer and without government support, Lehman had run out of options. Early on Monday, September 15, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection. The numbers were staggering. Lehman listed around $639 billion in assets and roughly $619 billion in debt, making it, by a wide margin, the largest bankruptcy filing in United States history. A 158-year-old institution with tens of thousands of employees had gone from the fourth largest investment bank in the country to insolvency. The market reaction was immediate and violent. Lehman's own stock had already collapsed 93% from its close just days earlier. The Dow Jones Industrial Average fell about 4.5% in a single day. At the time, its largest drop since the markets reopened after the September 11 attacks. But the truly dangerous consequences were not inside Lehman. They were everywhere else. Because Lehman was so deeply interconnected with the rest of the financial system, its failure sent a shock through markets that had assumed a firm that large would never be allowed to simply collapse. Panic spread. Lending between banks tightened sharply as institutions suddenly feared that their counterparts might be next. Money market mutual funds, a source of short-term credit that much of the economy relied on, faced a wave of withdrawal demands as investors rushed to avoid losses. In the weeks that followed, the crisis that Lehman's fall helped ignite contributed to the erosion of enormous value across global markets. On the order of trillions of dollars of market capitalization wiped out in October 2008 alone. Governments and central banks around the world scrambled to contain a financial panic that now threatened the entire system. The legal aftermath, by contrast, was strikingly limited compared to the scale of the damage. Executives, including Richard Fuld, were subpoenaed and faced civil litigation, and the Valukas examiner's report laid out its findings about risk-taking and about Repo 105 in more than 2,000 pages. A civil class action lawsuit was filed on behalf of investors, but no senior Lehman executive was ever criminally convicted for the firm's collapse. The reckoning was financial and reputational far more than it was criminal. The Lehman collapse is one of the most studied failures in financial history, and its lessons are structural rather than simple. The first lesson is about leverage. Leverage is not inherently wrong, it is how much of modern finance operates. But leverage is symmetrical in a way that is easy to forget in good times. The same ratio that multiplies gains when assets rise multiplies losses when they fall. At roughly 30-to-1, Lehman had almost no margin for error. A relatively modest decline in the value of its assets was enough to threaten the entire firm. High leverage does not create risk out of nothing, but it removes the cushion that lets an institution survive being wrong. The second lesson is about the mismatch between short-term funding and long-term assets. Lehman held assets that were hard to sell quickly, and it funded them with debt that had to be renewed daily. That structure works beautifully until the day lenders hesitate, and then it fails almost instantly, because there is no time to adjust. A firm that must borrow every morning to survive has handed its fate to the confidence of others. The third lesson is about disclosure, and it is the one the examiner's report emphasized. The problem the report identified with Repo 105 was not that repurchase agreements existed, they are ordinary. The problem, as the examiner described it, was using an accounting treatment to make the firm's leverage look materially lower than it was, while presenting those better-looking numbers to investors as good news and not disclosing the maneuver behind them. When the numbers of firm reports are managed to hide the risk rather than reveal it, every party relying on those numbers is making decisions on a false picture. The fourth lesson is about interconnection. Lehman's failure was catastrophic not only because Lehman was large, but because it was woven into the rest of the system. Its collapse taught regulators and markets a hard truth about what is now called systemic risk. That the failure of one deeply connected institution can transmit panic to everyone at once, freezing the credit that the entire economy depends on. Much of the financial regulation that followed the crisis was an attempt to address exactly that danger. And there is a final, sober lesson in what did not happen afterward. For a collapse this large, with consequences this severe, the criminal accountability was minimal. No senior executive was convicted. That outcome has fueled debate for years about how the law treats failures at the top of the financial system. It is not the place of this account to resolve that debate, only to state the facts plainly. The examiner found the reporting materially misleading. The individuals involved denied wrongdoing or contested the findings. The cases were civil, and no one went to prison. Lehman Brothers did not fall because a single person stole a fortune. It fell because a 158-year-old institution had built itself on borrowed money, thin capital, and risky assets. And then, when confidence vanished, discovered that there was almost nothing underneath. In the end, the oldest danger in finance is also the simplest, owing far more than you can cover and depending on everyone else to keep believing you can. This video is for educational and informational purposes only. All information is sourced from publicly available documents, regulatory filings, and credentialed news organizations. The characterizations of Repo 105 reflect the findings of the court-appointed bankruptcy examiner's civil report. Those findings were contested by Lehman personnel, and no Lehman executive was criminally convicted in connection with the firm's collapse. Source links are available in the description.